Hello everyone, good afternoon and welcome to today's, let me take this off just for a moment. Very welcome to today's Trade in the US Open live here at the Live Trade Room. And today is Thursday, 25th of October. So we're professional traders. We trade the markets with live capital every day. And what we look to do is to identify high probability trading opportunities, look to execute trades in this market with a high degree of consistency in our approach, with a view to manage those trades with discipline. And what we mean by that is looking to mitigate risk as quickly as we can, and looking for opportunities to let those trades run and just manage them proactively with one aim, and that is to book in consistent returns on over the medium and longer term. So just before we begin then, if we could start with our risk warning, please do of course familiarize yourself with the risks involved in trading these markets, and do take note of the risk warning currently up on screen. And before we begin, it's important that every trader has an understanding of some of the potential news events that could impact the trades. The reason why we say this is of course, it would make a lot of sense to suggest that you would want to know if there is an ECB press conference with Mario Draghi, if you were planning on getting in to the euro, for example, if you were looking to buy or sell the euro dollar in the build up to that 1:30 news event. So it's a good example. We've had the refinancing rate come in at 0. The ECB are broadly sticking to its plan to kind of rein in its stimulus. Since the financial crash, there's been an injection of large amounts of capital made available, and the ECB are now sort of in the process of trying to reduce down that incredible spending. So that's what we're likely to hear from Draghi. Of course, his opinions on a whole variety of things, from increasing interest rates to Italy, Brexit negotiations, I'm sure are all going to weigh very, very heavy. And we'll see. We'll have a look at the euro very, very shortly, so you can see how the euro has reacted initially to the refinancing rate. No major surprise really there by any stretch. And we have I suppose the major news for the market is Draghi's press conference at 1:30. So we're going to broadcast it so you can listen to what's being said, and we'll contrast it with some price action so you can sort of tangibly see how these news events can impact the trading charts. So we've got a bit of time, so let's go ahead and look into. We're in a couple of trades already this morning. They're both in a bit of profit. However, slow grinding price action higher, not explosive moves by any stretch. So the first trade was entering the dollar yen at the 112.31 level, and now we're up at 112.38, potentially looking to push this market higher. And the same situation for the S&P. We are in this market getting in at the 26.83 level. We're just marginally above that level now as we speak, but if I just show you, we were in a little bit of profit and it's just come back, just rolled over to the downside. But we can certainly, if we get a break above the 26.91, we'll certainly look to mitigate risk on the trade. But these are two very small trades. They are correlated. If we get a bit of buying coming into the US stock markets, then it's likely to weaken the yen. So there's a little hint of a risk on approach. Now all of that could change on the US Open at 2:30 p.m. London time. So we kind of need to weigh that up, and maybe if we get an opportunity to book in profit prior to that, maybe we take it and err on the side of caution. Because what we've seen, from the opens is initially decent, significant moves followed by strong reversals and continuation. The other market we were looking at today was buying the oil market above the 66.50 level, and you can see we've had a bit of a break. We've bounced back to the 66.71, and there is your ideal opportunity to buy this market. Wasn't at the trading desk at the time, unfortunately, so wasn't able to capitalize on it, but it's a bit of a no-brainer trade. It's the level that we were discussing this morning, and you can see it's come back to it, turned around. This is on a 15-minute time frame as well, so we're now getting that accelerated move to the upside. So currently in a couple of profitable trades, we'll continue to manage those. I suppose all eyes will be on the Eurozone. So we have this market just bouncing off the 1378, which is yesterday's low, and it's strengthening a little bit. Let's see what's happened so far over the course of the day. You can see since certainly the European session that we are effectively just moving sideways. In fact, there is probably an argument to suggest, sorry, let me put this on. So there's an argument to suggest that there's from a technical perspective, that there's a bit of funneling of price. So there's your narrowing of price action. What I'll do is I'll take both of these off again and just draw them. Just draw a better narrowing. So this is what we've had, an extended move to the downside. We've bottomed out. We've tried to reverse a little bit. Not really been that successful. And we're just getting, over the course of the session, we're just getting this kind of narrowing price action. So with that in mind, the levels that become quite important to us, and we do need to understand that we have the 1432 just above these levels, but the 1419 to the upside in the euro dollar, and the 1369 to the downside. So above 1420 and below the 1400 is kind of where we're at in terms of a breakout of this market. So we'll come back to the euro dollar, just because we wouldn't want to be getting into any particular trade pre Draghi. After yesterday's dollar strength, and you can see how hopefully you can look at this move and you can see after each you know, really strong move, we've had a really significant pullback, retracing the vast majority of the move, starting in here, and that's a bit of a concern. And this was a bit strange as well, where we gapped lower and then this market was bought up. So there is opportunities for the pound to strengthen, but every time we sell off, we retrace the majority of the move. We sell off and we retrace the highs. We sell off again, and now the idea is we might see, you know, a significant retracement. But what we do need to bear in mind is things have slightly changed. We've now got a really strong structural failure at this level, pushing prices lower, and you have the weight of this market leaning on these prices. So if they roll over to the downside, there's your high probability trade. Okay, so that's the pound dollar. So looking at the dollar yen, I mean, all we're literally doing is we're already in this trade on a daily time frame to the upside. I'll get rid of a few of these, and we're seeing this rejection of the lows, and we're just seeing if we actually get a strong retracement. We do. Once these markets become less risk averse, we would see perhaps a weakening of the yen, which is likely to benefit the dollar yen to the upside. So we're kind of still in that trade, happy to be in it, and we've just taken this morning we've taken more of a speculative medium probability opportunity to the upside with a really small stop loss, which we can mitigate very, very quickly, but we would anticipate this market to continue higher. The dollar Swiss is bouncing off parity. As you can see, it could be a tough level for that market to break. So we'll just stand back from the pound Swiss at the moment. Dollar CAD rolling over to the downside, but we've retraced a little bit of that move. So really, we're still anticipating this market to push higher, actually. So we'll see if we do get those opportunities, but clearly probably not today. A bit of strength coming back in to the Aussie and the New Zealand. So there's, if you want to buy dollar and pound weakness, there's definitely some better opportunities than the Aussie and the New Zealand. Potentially even the euro dollar could be classed as one of those. Let's look at that in the 15-minute time frame. So there is a potential for a bit of a move between 14.20 and 14.40, or maybe even back up to the 14.50 level. So probably let's reserve a little bit of judgment with those. Looking at the yen pairs, seeing a bit of a retracement, not much movement since this morning. To be fair, in a similar situation, slight movement to the upside in the euro yen. And that's in keeping with a bit of European strength beginning to creep back in. So we were talking this morning about, you know, how tough the euro pound is, and broadly speaking, look for opportunities to sell around 90.36 and look for opportunities to buy around the 8700 level. Now this is 87.20 up here, so we're not too far away, but it just shows you the potential for a really nice bounce. Likely to come into a little bit of resistance around these sorts of highs, just a little bit higher than this current level. So with the erratic nature of the euro, and we have Draghi speaking in a minute, we probably don't need to be making decisions on that. So we're not gonna add to any of our trades for the time being, and just see how some of these markets start to behave. Strong sell-off off the 12.39. That's our level of resistance, and as you can see, it's worked quite nicely, and we've had a strong rollover to the downside. So if we break below today's daily low, we'd expect continuation lower, but the move to the upside is by no means over. I'm sure we'll get extended moves to the upside. We just need to be careful and look for the opportunities. So this is a really good opportunity to the upside. It would have been a nice profitable trade. It's still squeezing higher, so we just need to identify the levels that gives us the best opportunity to get into it. And as you can see, you could sort of work with that, and the market bounced exactly off the 66.96, so that was the next level to get into. So we do quite like the idea of a what's called a so we'll come back to these. Let's continue to look at the oil. So it's a counter trend move, so we very clearly have really strong moves to the downside, and this is what's called a counter trend move. So we are trading it on that basis. Let's look at it in 15, and the next level to provide resistance is kind of in and around the 67. So there's plenty of scope. 67, 68. So there's plenty of scope to the upside. We just need to perhaps look for that opportunity. Strong move in UK oil. Yeah, S&P 500. We do anticipate this market to continue to squeeze higher. Again, it's a counter trend move. Counter trend move to the upside. Okay, so we'll see how we go with these. So we're just getting a bit of a risk-on approach today to these markets. So all of these things will support our dollar yen trade. So we had such neat opportunities to get in to the dollar yen and also the S&P. We decided to get into both of them, but we were initially going to just focus on the dollar yen trade. If we just break above the 112.40 level, we can then take risk off the table for the trade. So let's see if this continues and if we get a strong push higher. Okay, so we will focus now on Mario Draghi in the ECB, and we'll keep a very, very close eye on the euro dollar. So I think we'll probably revert back to the markets that we were looking at, plus the euro dollar, so we can make any decisions as and when we need to. Okay, so we got the euro dollar top left, we have the dollar yen bottom left. Let's also get up the oil markets. So the US oil, yeah, we'll keep an eye on this on the bottom left hand corner. And top left we can have the S&P. So you can see the potential for, you know, a little bit of a clawback off the back of the last couple of trading days. See if some momentum starts coming into the upside. All we're seeing at the moment is kind of sideways moving consolidation, so not filled with the best opportunity potentially, but I mean, below the 26.76, there's only an 8-point stop loss on this market. So we did have a 1-to-1 up at these levels, the 26.91 level, but we were expecting it to just squeeze higher, but we obviously didn't get that follow through, and now we're just rolling over to the downside. So we shall see on this trade. We had the slow grinding price action higher, so we're quite happy to be in them. We don't need to. I suppose the trade that we've missed on a couple of occasions is the US oil market. So I suppose that is some of the difficulties of trading. Obviously, you can't be at these desks watching the charts 24/7, and we've got a couple of other projects we're working on as well. So I suppose we're a little bit distracted with some of these entries, but you can see the basic principle of the trade. The pullback off the highs, back to levels of support, you get the next move higher, back to support, next move higher. So really that's why we look at focusing at buying. If you get the opportunity at the 66.50, that's a strong breakout trade. If not, you got the 61.71, sorry, the 66.71 as an opportunity to buy, and then if not, you got the 66.96, and on each of those occasions you would have had a strong move in the oil market. So that's how, I suppose, uncomplicated trading can be sometimes. You just need to have enough confidence in your approach and understanding to know that it is a counter trend trade. We will potentially reduce risk or reduce down our exposure, or, you know, not take on a large monetary exposure in the trade. All of the above applies with counter trend moves, but they can be quite good trades as well. So I wonder if we get another opportunity to get into it during the session. That would be nice, as opposed to sort of the latter part of the European Open. which is a bit of a shame. So, okay, let me see. So I've got 5 minutes before the news is out. So what we'll do is we'll start getting prepared for this. Okay, so we'll switch over to Draghi now. I'm just keeping an eye on the news flow, and when he comes online, we'll be able to listen to him for a little while. So let's see what he says. But most importantly, we'll keep an eye on what the euro's doing. If it begins to sell off, we need to be mindful that it's a counter trend move to the upside, and if it's a movement to the downside, it's very much trend related. So again, might give us both opportunities in either direction. So hopefully it'll be an interesting session for us. Okay. Hello, Keith. Nice of you to join us. Are you PWR? I do apologise. I'm not sure what that acronym refers to. I know what it refers to in a completely different industry, but with regards to trading, I'm not too sure what PWR pertains to. Perhaps you could just clarify in the chat box for me, Keith. I'll be happy to answer that question for you. So I'm just posting a little note into the chat box. Power Ranger. Nice one, Renko. Signals. Yeah, that's one of the projects we're working on actually at the moment, Keith, is kind of an operational sort of signal service. We do appreciate many of you are kind of juggling many other commitments and perhaps don't have the time to, you know, wait for those opportunities, and quite often sort of wait quite patiently for the right opportunity to fire up. So we are actually developing our signal service. We are hopeful that we'll be able to make announcements on it next week. So perhaps you could bear with us. And it's something not just yourself is mentioning, but many others have mentioned it as well. And that's really where we can just put our high probability trading opportunities in a vehicle that you can access, you know, instantly, and you can look at those for real viable trade opportunities. And this signal service is going to be based largely on pending orders, so you'll be able to place them in the market. So it's there's still signals that are kind of based in the methodologies that we look for, you know, to trade consistently with. You won't really see sort of random, erratic sort of trade signals. They'll all be based in kind of pretty strong principles, which is, we think is quite important. So it's our own version of a signal provider, and it'll be made available to our current members. I don't know, Keith, are you a member of the Live Trade Room yet? I mean, if not, very welcome to join us. Currently offering a 14-day free trial below. Go to our website, www.thelivetraderoom.com, see the membership packages. Very welcome to join us. And if you do want to join us, and you can access 76 live trade rooms per calendar month, just for $9.99 per month, and that will include the signal service. So yeah, we're building a lot of stuff in the background. I'm sure a lot of stuff that will be really interesting, and what we're trying to do is just to cater for a wider variety of trader, with time availability being a bit of a concern for many traders. We do know that. Okay, so we're getting the move to the upside a little bit more now in the dollar yen, and just looking at the euro dollar, as you can see, and I'm just looking off air as well, just to see if so here he comes. He's on his way to the desk. So let's I'll bring it up on screen now, but I'll let you listen to it for a bit.
So we're definitely seeing Mario Draghi settle down, sit down.
Do let me know if you have any sound issues.
This guy, he was like on time last time.
He knew we had to do the numbers too.
Exactly. That was really helpful. Mike, one quick thing is that you look at wholesale inventories; they were just up 0.3%, so disappointing. Retail inventories coming in 0.1%. Walk me through what that means for the.
Well, if inventories are down, it's not as good a news for growth overall. Now, wholesale inventory is very closely tied to trade. So if the trade deficit is going down, if exporters, we don't have those numbers yet, since this is just the advanced number, but if exports are and imports are down, you're going to have fewer inventories on the docks. Retail inventories, you know, if companies want to build up, they got to sell more, they got to have more inventories.
All right, Bloomberg's Mike McKee, thanks very much. And tomorrow, don't miss his exclusive interview with Robert Kaplan, the Dallas Fed president. There you are, looking at Mario Draghi beginning his speech at the press conference, no doubt front and center for him.
Gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council, which was also attended by the Commission Vice President, Mr. Dombrovskis. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged, We continue to expect them to remain at their present levels at least through the summer of 2019, and in any case for as long as necessary to ensure the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. Regarding non-standard monetary policy measures, we will continue to make net purchases under the asset purchase programme at the new monthly pace of 15 billion euros until the end of December 2018. We anticipate that, subject to incoming data confirming our medium-term inflation outlook, we will then end net purchases. We intend to reinvest the principal payments from maturing securities purchased under the APP for an extended period of time after the end of our net asset purchases, and in any case for as long as necessary to maintain.
So just briefly, we can probably take a little bit more of a full picture look really at this. This is on a 15-minute time frame, so let's bring it right down, and you can see how these markets can respond and react to central bankers. So clearly there's a bit of optimism to the upside. Before I put Draghi on, I just want to see if there's a level that we can work with. We do have the 1432, so we're only a little bit below that. So maybe we look for an opportunity where if we get a break above 1432, we look to buy the pullback in and around this level. So maybe we'll just let this market do its thing for the short term. So perhaps no urgent decision necessary on that. And I can see the oil market continuing to just drift away, which is a bit of a shame. Okay, let's go back to Draghi.
This support will continue to be provided by the net asset purchases until the end of the year, by the sizable stock of acquired assets and the associated reinvestments, and by our enhanced forward guidance on the key ECB interest rates. In any event, the Governing Council stands ready to adjust all of its instruments as appropriate to ensure that inflation continues to move towards the Governing Council's inflation aim in a sustained manner. Let me now explain our assessment in greater detail, starting with economic analysis. Euro area real GDP increased by 0.4% quarter-on-quarter in both the first and the second quarter of 2018. Incoming information, while somewhat weaker than expected, remains overall consistent with our baseline scenario of an ongoing broad-based economic expansion supported by domestic demand and continue.
You can see the erratic flashing nature of this price action, and what we're seeing here is with the exchanges, and you're seeing large volumes come in and out at incredible speeds, and you're getting this flittering kind of appearance on the screen. It's just interesting to see who is going to win out in this particular little battle. And as you can see, there's the impulses pushing higher, but they're constantly getting sort of pushed and driven lower. So sort of interesting price action, very kind of erratic, but still we're only looking at a 12 pip range, so fairly muted considering you can have situations with central bankers where the market could move 100 pips in about 30 seconds. So very, very muted, grinding higher, grinding lower, no real direction just yet.
Vulnerabilities in emerging markets and financial market volatility remain prominent. Euro area annual HICP inflation increased to 2.1% in September 2018 from 2% in August, reflecting mainly higher energy and food price inflation. On the basis of current futures prices for oil, annual rates of headline inflation are likely to hover around the current level over the coming months. While measures of underlying inflation remain generally muted, they have been increasing from earlier lows. Domestic cost pressures are strengthening and broadening amid high levels of capacity utilization and tightening labor markets. Looking ahead, underlying inflation is expected to pick up towards the end of the year and to increase further over the medium term, supported by our monetary policy measures, the ongoing economic expansion, and rising wage growth. Turning to the monetary analysis, broad money M3 growth stood at 3.5% in September 2018 after 3.4% in August. Apart from some volatility in monthly flows, M3 growth is increasingly supported by bank credit creation. The narrow monetary aggregate M1 remained the main contributor to broad money growth. The growth of loans to the private sector strengthened further, continuing the upward trend observed since the beginning of 2014. The annual growth rate of loans to non-financial corporations rose to 4.3% in September from 4.1% in August, while the annual growth rate of loans to households stood at 3.1%, unchanged from the previous month. The Euro Area Bank Lending Survey for the third quarter of 2018 indicates that loan growth continues to be supported by increasing demand across all loan categories and favorable bank lending conditions for loans to enterprises and loans for house purchase. The pass-through of the monetary policy measures put in place since June 2014 continues to significantly support borrowing conditions for firms and households' access to financing, in particular for small and medium-sized enterprises and credit flows across the euro area. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is still necessary for the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. In order to reap the full benefits from our monetary policy measures, other policy areas must contribute more decisively to raising the longer-term growth potential and reducing vulnerabilities. The implementation of structural reforms in euro area countries needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost euro area productivity and growth potential. Regarding fiscal policies, the broad-based expansion calls for rebuilding fiscal buffers. This is particularly important in countries where government debt is high and for which full adherence to the Stability and Growth Pact is critical for safeguarding sound fiscal positions. Likewise, the transparent and consistent implementation of the EU fiscal and economic governance framework over time and across countries remains essential to bolster the resilience of the euro area economy. Improving the functioning of the economic and monetary union remains a priority. The Governing Council urges specific and decisive steps to complete the banking union and the capital markets union. And we are now at your disposal for questions.
Mr. Kouani?
Balázs Korányi from Reuters.
Okay, so just to give you a little bit of insight, we've had Draghi making his statement to the markets about the Eurozone and some of the decisions that have been made and projections and impact on inflation, things like that. And we've only had what is effectively a 18 pip range during that whole time. So now it's going to get quite interesting because the media are going to ask a whole variety of different, more challenging questions, and we'll see how Draghi reacts. But as far as a Draghi statement is concerned, this is very much ineffectual. It's clearly not designed to move price too much. And the euro-dollar is a really good indicator for directional bias. So so let's see the difference between the statement, whereas obviously they've got time to plan and really focus on what they're going to say and how they're going to say it, knowing that every single word that they mention is going to be scrutinized. And as we can see, not much of a reaction, slightly more bearish than positive, but that can change in an absolute heartbeat. But now the challenging questions are going to arrive. So maybe we just listen to a few of these and monitor and just take note of what's happening in the price action while he's doing so. So I'll pass you over to Mario Draghi once more.
Above, and in some cases well above, historical averages, and certainly is certified by slower growth. So then the issue is, what are the reasons behind this weaker momentum and these weaker survey indicators? And here we go into a variety of explanations, one of which certainly is country-specific factors, so-called idiosyncratic phenomenon. Think about the car sector in Germany. This is having quite a powerful effect for this quarter, but not next quarter. So the other next question is, well, first let me go through the various things. The second is the export performance. Last time we discussed the export performance, saying that last year, 2017, had an extraordinary export performance. Now we're coming back to normal. And so we had a decline in exports that seems now is reflected in the current weaker momentum, but seems now come to a halt. Then, of course, we have trade uncertainties. We have the stalemate between US and China, with Brexit, with Italy, with financial markets volatility, so a bunch of uncertainties. And then we have perhaps the important part of explanation, it's simply that we're having growth returning to potential after 2017, where it was clearly above potential. So it's not simple here to distinguish what is transitory from what is going to be permanent, what is country-specific to what is from what is extended to the whole of the euro area, and what is actually having an impact on consumption and investment, and what is not having an impact. For one thing, we still observe consumption pretty strong, buoyed by an expanding employment, an expanding labor market, rising wages, and so business investment. So also the emerging market economy situation seems to have stabilized somehow. So all in all, the assessment of the Governing Council was, yes, there is a weaker momentum. Yes, there are weaker survey data coming out, and maybe some more are expected in the future. But is this enough? Is this enough of a change to make us change the baseline scenario? The answer is no. The balance of these risks are not being considered at this point in time enough to change the balance of risk. Now, of course, we'll have to see the projections in December, and that was also one other consideration. I will elaborate on inflation and monetary policy later. On Italy, you have to remember that Italy is a fiscal discussion. So there wasn't much discussion about Italy. As a matter of fact, the Vice President Dombrovskis was there, and basically I asked him permission to quote him, to quote what he said. He said, of course, we have to we have to observe and apply fiscal rules, but we're also seeking a dialogue. I think that's what it is, but then I can answer other questions about the facts. Thank you.
Mr. Conti.
Good afternoon, Mr. President. Still, again, about Italy. I would like to refer to your recent statements that the Italian situation was not posing any risks of contagion. So my question is whether you confirm this statement or whether it has changed.
No, I didn't say it was any risk of contagion. I said that at that point in time there was no sign of contagion. It's different. Yes. Okay, let me also respond to the other part of the question was asked before about what are the facts. First, let me say what's the context. The context of our discussion today was, as I said before, the statement by the Vice President of the Commission who said, of course, he has to apply fiscal rules, but he's also seeking a dialogue. The second point of context is what I said in the previous press conference in the IMF during the course of the IMF meetings, is that I'm personally, but that's a personal perception, so take it for what's worth, I'm confident that an agreement will be found. Now let me come to the facts. Interest rates have come up and are coming up. And so that means the lending rates are going up, still moderately, I should say, for households and for firms. And so it means that households will have to pay more for borrowing from banks, and so do companies. Of course, companies, in the case of companies that fund themselves issuing bonds, the pass-through from the capital markets to the bond market, to the corporate bond market, is obviously faster. So for them, the increase in borrowing rates has been more marked and quicker. Now, all this likely means that will have effects on credit and ultimately on growth. And, by the way, on the very same space that's needed for fiscal expansion. So, in a sense, after the interest rates, if the interest rates keep on going up, the room that is available to expand the budget gets smaller. On the facts concerning, there is, as I said, the increases in interest rates have been there now for a while. We've analyzed in both through surveys and through direct evidence these increasing rates, but these increasing rates are not so far, at least banking rates, are not significant or not material. However, we have now the bank lending survey of this quarter, and it does say that basically terms and conditions applied by Italian banks on new loans to enterprises and households for house purchases tightened. Terms and conditions, so no standards, terms and conditions tightened in the third quarter of 2018, driven by a higher cost of funds and balance sheet constraints. Now, what about the spillovers? Since the last time I commented about this, we have observed some increase in interest rates in some other countries of non-core countries, let's call them this way. It's not...
Okay, so what's quite interesting is the flickering of the erratic rejections of the highs in the 1428 as price gets up here. Okay, it's moving there, but it's moving very differently now than what it is when it starts pushing up to the 1428. It's just interesting to just notice the execution of trades as this market tries to push higher, and we've had a few rejections now of this 1428. So so here it's looking fairly solid, and as it starts getting up to these levels up here, you'll start seeing the difference start to kick in again. There's that sort of difference in kind of volatility kicking in. So good example. Unfortunately, we still anticipate the S&P 500 to push higher, but we've just had this slowly grinding lower price action, so we can certainly back off that market for now.
My second question is on inflation. What is justifying your confidence on inflation pressures, given that core inflation rates have actually disappointed several times this year, and as you said, there are certain geopolitical risks that seem to be increasing? At what point do you worry that the wage and inflation pressures that we see are going to be short-lived?
Yeah, let me answer first the second question. The discussion in the Governing Council showed that there isn't much of a change in inflation, really. But when we look at surrounding developments, we see that negotiated wages keep on going up. This is a very comforting sign, because it means that wage increases, which, by the way, in some core countries have been quite significant, wage increases are going to stay. They are not temporary, they are not drift determined, but they are negotiated wages, so they're going to stay, and they've been, they've been quite, in some countries, significant, but in general, nominal wage growth is picking up. The other thing is the labor market keeps on expanding, but it's progressively, gradually tighter and tighter. And the third thing is that capacity utilization rates in most countries are pretty high. So frankly, after all this assessment, we have no sense that we should doubt about our confidence that inflation is gradually converging to our aim. But having said that, we reaffirm the fact that our monetary policy needs to remain accommodative, and a considerable degree of monetary accommodation is still needed. I see that there are lots of concerns, well, not lots, some concerns about APP maybe ending at the end of this year. Let me tell you one thing that I've said on and on and on. Even if it were to end, monetary policy will remain very accommodative by the reinvestment, especially the reinvestment of the considerable stock of assets that we have in our balance sheet, and our forward guidance about interest rates. And let me read this about the introductory statement to this sentence. It says, this support will continue to be provided by the net asset purchases until the end of the year, by the sizable stock of acquired assets and the associated reinvestments, and by our enhanced forward guidance on the key ECB interest rates. In any event, the Governing Council stands ready to adjust all of its instruments as appropriate to ensure that inflation continues to move towards the Governing Council's inflation aim in a sustained manner. So that's what I can say about inflation. On Italy, I mean, I don't have a crystal ball. I don't have any idea whether it's 300 or 400 or whatever. So it's difficult. But certainly, these bonds are in the bank's portfolios. If they lose value, they are denting into the capital position of the banks. That's obvious. So that's what it is. So you have one may have, but as I said, I'm still, I shouldn't say optimistic, but I'm still confident that an agreement will be found. That basically, yes, you have a dent in capital position. Then, of course, you have a weakening funding conditions as well. And all this is going to translate into different lending terms.
Mr. Fallis?
Thank you. Tom Fallis from the Wall Street Journal. Mr. Draghi, you mentioned that you thought there would be a deal between Italy and the EU. Do you sympathise at all with what Italy's argument is, that it needs more budget flexibility, given also that its budget deficit is still planned to be below 3%, even if that isn't how the Commission sees it? Do you sympathise with their argument? The second question is on the rise in market interest rates in Italy and Spain and Portugal. How much of that do you think can be traced to the end of QE in December, and what would it take for the ECB to extend? What would the ECB need to see to extend QE into next year? Thank you.
Now, we haven't talked about any extension. As you've seen, the language is exactly the same as before. And as I said a moment ago, you have to consider the monetary policy will remain very accommodative, even in case we were to decide to end QE at the end of the year. Now, will the end of QE put pressure on spreads? You know, by and large, let me say first one thing, let me repeat one thing. Over the past few months, we have not bought Greek bonds, but we have bought Italian bonds. And still, in spite of that, we saw that the spreads between Greece and Italy narrowed down. So, in the case of a suspension of QE, you would expect that spreads are going to be affected depending only on the net issuance of different countries. Okay? That's the answer. So by itself, if countries were not, if countries in the hypothesis that they were having the same degree of issuance, the same net issuance, you wouldn't see any change in spreads. So it's not, the end of QE is not a selective measure addressed to any specific country. It is a measure, it's a monetary policy measure that it's justified by our confidence in the convergence to our aim. Now the first question is whether I have sympathy for this or that. I mean, I don't know what to respond with that. And we have the Commission. The Commission is the ultimate guardian of the Stability and Growth Pact, not the ECB.
Ms. Iniguez?
I have a question about Spain. The Spanish High Court has decided that the banks have to pay the stamp duty of a mortgage and not the customers. What do you think about it? Do you expect an impact in the profitability of the Spanish banks?
I will completely defer the answer to the Vice President of the ECB.
Well, we do not comment on, any sort of ruling from the courts. We respect, the rulings from the Supreme Court of Spain.
Ms. Jones?
Claire Jones, Financial Times. Would it be possible to get some sense of what exactly the options are for the Governing Council should the news flow remain as poor as it has over the past...
Sorry, should
the news flow, should the data continue to be bad? Should the market turmoil continue? Should relations between Rome and Brussels worsen? And you are forced to downgrade your assessment for the outlook. It seems as though there's a very high bar to continuing to expand QE past the end of this year. So are you starting to talk about what you could do with reinvestments or what you could say on the path of interest rates? And for my second question, both the European Central Bank and the Federal...
Okay, some interesting developments there. So what we need to do is to sort of make sense of it and be able to apply this news event and see what opportunities it gives us as traders. That's ultimately what we want to do and focus on. And what we're actually going to do, guys, and apologies, we've just gone over the 2 o'clock. We do have traders over in our live trade room, so I do need to switch across. But just very briefly, it's a non-event effectively. Now we might get some, once he's finished speaking, we might get some continuation potentially on the further to the upside in the euro, in keeping with its sort of directional bias for the day, which is just trying to retrace a little bit of yesterday's move. So we can look for continuation. However, we're inclined to sort of run into this weekly low level, which is something that we were wanting this price to clear, and it hasn't really been able to do so yet. So with the euro, I mean, we've really not, we're just consolidating with a slightly bullish biasness on that. We're going to switch across now to just to conduct a bit of a review of all the remaining markets. The S&P is looking like it's gonna kind of roll over to the downside, so let's see if that's the case. Oil has been a little bit erratic. We broke above the 67.28, but then we kind of reversed and we actually broke and made a new low, and now we're just in the middle somewhere. So price action's not looking that great today, to be honest. The dollar is strengthening against some. It's sort of mildly weaker against the other, like for example against the Aussie and also New Zealand. So they've strengthened quite considerably. Euro strengthening against the pound, pound yen, euro yen, all strengthening a little bit off its lows. The gold market just bouncing off its highs, 12.39. Looking a little bit indecisive. The US oil, we've seen the moves now, and now we're just in this sort of sideways range. Actually, potentially looking like we're going to squeeze lower, which is a bit of a game changer to the downside from a technical perspective. But sort of mild support, I guess, so far in the UK oil. And the equities look like they're kind of interested in just rolling back over to the downside. So again, no major surprise with any of these moves today. So I suppose we only got into 2 trades with very, very small stop losses, and we're still in one of them with the expectation for it to continue higher. So let's see if that's the case. Euro dollar just literally moving sideways. And we're getting a bit of a rollover to the downside now in the dollar yen. So it's likely to run into a little bit of support somewhere in and around these prices, which is why we've got a stop loss just below that level. So that's what we're going to work with. So on that note, guys, we're going to switch across to the live trade room now. Please do take us up on our offer. If you would like to join us, you get 2 weeks free access to over 76 live trade rooms per calendar month, and lots of other products and services, and a whole wide variety, a range of education in there as well. So do read the details below, and very welcome to come on board. And you can connect with us through our YouTube channel. Just search for the Live Trade Room, all one word, and subscribe to our channel. Do give us a thumbs up on this video if you can. And you can also connect with us through our Facebook, Instagram, Twitter, and LinkedIn. The details are all there up on screen. So all that's left me to do now is to thank you very much for joining us. As always, do take care. We're switching across to the Live Trade Room now. So from everyone here, we'll speak to you soon. Bye for now.